The sooner one starts to invest, the better chance they have of ultimately achieving their financial goals. Being able to stay in the market for as long as possible gives you the best chance of getting to where you want to get to. There's an ever-changing landscape, politically, regulatory-wise, so being able to have the flexibility to react to that is really important. Staying in the market also allows you to benefit from compound growth, which really is the key. Albert Einstein described it as the eighth wonder of the world. And really that is the key. The longer one can stay invested, the better chance they have of ultimately achieving their financial goals. To really benefit from compound growth, it's important that you're able to remain invested for as long as possible and not take money out of your investment. The biggest increases in the market tend to follow the biggest dips in the market. So if you sell out during the bad times, the likelihood is you will miss out on better times when the market recovers. And in fact, if you look at the data between 1992 and 2002, if you stayed invested throughout that whole period, you see overall returns of 807%. If you miss just the best 10 months within that 30-year period, your returns would be down to 275%. A massive drop just by missing 10 months out of a 30-year period. A key to successful long-term investing is exhibiting good behaviours. It's not necessarily the smartest people that always see the best returns on their money. It's about sticking to your guns and making sure that you remain in the market. One thing that we say a lot to clients is not about timing the market, it's about time in the market. If you'd invested £100,000 in the market over the last 20 years, you would have seen growth to £644,000 over the last 20 years. If you've missed just the 10 best days in the market, your returns would be £357,000. We've talked a lot about investments and how they're an important part of your financial plan, but another really important part to think about is protection and insurance. It's all well and good having a financial plan in place with regards to long-term savings, but sometimes something happens which means you won't be able to continue to save for the long term. So it's really important to have the right protection in place, things like life cover, critical illness cover. It's also really important that people who are employed know what the benefits that they receive are from their company. If they move company, these are benefits that they'll potentially lose. And whilst they are employed, it's also important to know what top-up they might need on top of what they're already receiving from their company. Another misconception, I think, is that a lot of the time people think they have all the answers when it comes to financial planning, and it's something that they can do themselves without a professional advisor. And certainly there are lots of success stories where people have been able to do this. I would say over the long term, it's very difficult to outperform professional advice. And we see our jobs very much as a PT might see their job when you go to the gym. You can go to the gym, you can lift some weights, maybe do cross training and walk on the treadmill, but you're not necessarily sure that you're doing the right thing and getting the best results. People are willing to pay for a private personal trainer because they know that that's one way to sort of get the most out of their time and ultimately achieve their goal in the shortest and least painful way possible. We're very much like a financial PT. That's our job, is to help people do exactly the same with their finances.